fundsupermart.com.
In this webcast, we speak to Christopher Arbuthnot, Senior Managing Director and Senior Portfolio Manager at Manulife Asset Management, Boston, USA, to get his views on the opportunities in the global equities space. What is your outlook on the global equities for 2012?
I'm very favorable on the outlook for global equities due to a number of reasons. Number one, volatility has come down in the marketplace, and I think what that means is investors are going to focus more on fundamentals. And given that the fundamentals are improving for stocks, that's a reason to be excited. Number two, there's a lot of cash on the sidelines, cash that can move into equities. Number three, it looks like interest rates are going up in developed markets, and if that's the case, then there's a lot of money that can flow out of fixed income. And number four, stocks are attractively priced. If you look at them on a number of valuation metrics and compare them to history, it's telling you that now is the time to buy equities.
What are some of the key performance drivers of global equities?
Well, there's drivers that affect stock prices in the short term, and then there's drivers that affect stock prices in the long term. In the short term, it's very much sentiment, and we live in an interconnected world right now. And if something happens in Japan, like there's an earthquake or there's floods in Thailand, that can cause problems on the other side of the world as well, and that can cause shocks to the system, and that can cause sentiment to go negative. But at the end of the day, what matters long term is the fundamentals of individual companies, individual stocks.
What are the key risks of global equities?
Well, there's a lot of risks right now. I would say that the four biggest risks are a potential hard landing in China. I'm of the belief that China has a capital allocation problem. The way they responded to the financial crisis was through a big stimulus plan in which they spent 25% of GDP on big fixed capital investments. I think there's a chance that a lot of the banks that made those investments don't get paid back, and so it may make it more difficult for China to sustain their growth in the future. Number two is Europe. I don't think we're out of the woods yet. The LTRO facility that was put in place in December has certainly stabilized things, but there's a chance that there could be a shock coming out of Europe. I think also there's a risk of a spike in oil prices. It depends on how the U.S. and Israel respond to Iran. And then lastly, there's just a lot of elections going on in the world, in the U.S. and in Europe, and then new leadership in China. And there's question marks as to what those new leaders, what their stances are going to be going forward on policy.
What are the countries, sectors that you are paying closer attention to for 2012, and why?
Well, definitely Japan. We're of the opinion that the yen is probably at an inflection point where it's going to weaken, certainly versus the dollar. And so we're focused on Japanese exporters that trade very attractive valuations on price to book, and that can benefit tremendously from a weaker yen. Companies that have taken a lot of costs out of their operating structure over the last few years and can see their operating margin double, triple if the yen weakens versus the dollar and versus the euro. So we're very focused on Japan. We're also very focused on India. We love India long term. What drives GDP growth is demographics and productivity, and the demographics in India are very attractive. 42% of the population is 15 years old or younger. The country's starting to spend a lot of money on infrastructure. That will lead to productivity improvements. So we see a lot of attractive opportunities in India right now, and that was one of the worst performing stock markets last year. So incredible valuations that we're seeing there. And lastly, I would say in general, we're looking for opportunities in Europe. Companies that aren't tied to the economic growth of Europe, but sell globally, but companies that are in markets that were a source of liquidity for portfolio managers last year, such as Italy or such as Spain, where great businesses, global businesses that aren't tied to economic growth in Europe.
Which are the countries, sectors that you are not investing in or avoiding for 2012, and why?
Well, I mentioned China. I think we're definitely cautious on China. In terms of sectors, probably consumer staples and utilities. Consumer staples, very expensive. They're trading at 50-year lows on free cash flow yields, which means on a relative basis they're very expensive. And the same thing with utilities. If you compare them to where they've historically traded versus the market, they're more than one standard deviation away from that, and they typically trade with fixed income. So if you believe interest rates are headed up, which we do, that's negative for utilities.
If we narrow our focus on the US, do you think now is a good time for investors to buy into the US equity market?
I think it's always a good time to invest in the US equity market. There's always great opportunities there. I mean, right now we're seeing, the U.S. economy is probably one of the stronger economies in the world. We're seeing payroll growth that's strong. We're seeing consumer confidence come back. We're seeing the housing market seems to have recovered or is beginning to recover. We're seeing strong export growth. So the economic data coming out of the U.S. is improving. And then on a relative valuation basis versus fixed income, very attractive. If you take the yield, the earnings yield, and compare it to the yield on 10-year treasuries, it's the widest it's ever been, which is telling you that equities are very attractive. And then on a company by company basis, there's always attractive opportunities within the U.S.